The single most important price in the world is not oil, and it is not a stock. It is the price of safety, and after a decade of silence, it is signaling a systemic break. For nearly 40 years, the global financial system operated on a hidden assumption that US government debt was a risk-free, cost-free foundation for all other assets. But in the last 18 months, the term premium, the compensation investors demand for holding long-term bonds over short-term bills, has violently returned from positive territory. This is not just an echo of 1970s inflation. This is the sound of the entire post-1971 monetary architecture cracking, and here at Finance Saga, we follow the mechanisms, not the headlines. The consensus view sees high debt and geopolitical tension as the disease. In reality, they are the symptoms of a much deeper failure in the plumbing of the global dollar system. This isn't a story about one nation's budget deficit. It is a story about the end of a 50-year-old financial order. We are not just at the end of a normal debt cycle, we are at the end of a funding regime. The system in question is often called the Eurodollar system. This term doesn't refer to the euro currency. It refers to the vast, multi-trillion-dollar pool of US dollar-denominated deposits and loans held in banks outside the United States. Since the 1970s, this offshore, unregulated market, not the Federal Reserve, has been the true engine of globalization. It funds international trade, it provides the leverage for global banks, and it creates the vast majority of money that moves between continents. But this entire system runs on one critical fuel, high-quality collateral, which for half a century has meant one thing: US Treasury bonds. To understand the crisis now unfolding, we need a map of this mechanism. Imagine a simple, three-part flow. On the left, we have the global savings and collateral pool, Box 1. This is the source, primarily the $27 trillion US Treasury market. In the middle, the offshore intermediary system, Box 2. These are the shadow banks, the London and Tokyo repo markets, and the foreign exchange swap desks that use the collateral from Box 1 to create leverage. On the right, the macro outcome, Box 3, stable global growth and low inflation. For decades, the arrows connecting them, representing collateral chains and funding flows, were smooth and frictionless. The problem today is that the collateral in Box 1 is becoming too large and too volatile, causing the intermediaries in Box 2 to seize up. This fragmentation is why assets like gold, certain emerging market currencies, and even inflation-protected bonds are moving. They are not just speculative picks. They are the logical consequence of capital seeking an alternative to a failing system. The US dollar is not being replaced by a single rival. It is fragmenting as its foundational collateral, the Treasury bond, loses its risk-free status. The US didn't force the world to use its debt. The world demanded it as the only neutral, scalable, and liquid asset to clear global payments. But what happens when the provider of the world's primary safety asset becomes its largest source of risk? To understand how this ends, we must first understand how it began. The system wasn't designed, it was born from the ashes of the last global monetary order. This takes us to our first historical precedent, the 1971 Nixon Shock. The common narrative blames 1970s inflation on oil embargoes and government spending. The mechanical truth is that the underlying system, the Bretton Woods Accord, was already broken. Under Bretton Woods, the dollar was convertible to gold at a fixed price. By the late 1960s, global economic growth had outpaced the supply of mined gold. The US was bleeding gold reserves as other nations, correctly, called its bluff. The system was too small. When President Nixon severed the dollar's link to gold in 1971, he didn't just end an era, he accidentally launched a new one. The world, suddenly starved of a neutral asset to settle its accounts, was forced to find a replacement. It found one in the US Treasury bond. This was the moment our mechanism map was born. Box 1, global savings, was no longer a vault of gold. It became a ledger of US government debt. This new Treasury standard created the petrodollar system, where oil-exporting nations recycled their dollar profits back into US bonds, funding America's deficits in exchange for using its financial plumbing. This system worked brilliantly for 2 decades, financing a massive expansion of globalization. But this new market-based system, unlike Bretton Woods, had no central bank, no formal rules, and no lender of last resort. It was pure, unregulated financial machinery. And in 1997, the world discovered what happens when that machinery jams for the first time. The 1997 Asian financial crisis was not a regional event. It was the first catastrophic failure of this new, collateral-based dollar system. For years, the Asian tigers like Thailand, South Korea, and Indonesia had been economic miracles. But this miracle was financed by the Eurodollar market. Their local banks and corporations borrowed billions of cheap US dollars from the intermediaries in our map's second box, funding everything from skyscrapers in Bangkok to chip factories in Seoul. This created a fatal mismatch. They held long-term local currency assets but were funded by short-term US dollar liabilities. When the Thai baht broke its peg in July 1997, this mismatch exploded. Suddenly, their dollar debts were impossibly expensive, and the offshore banks, the intermediaries in Box 2, panicked and refused to roll over the loans. This is where the true nature of the system was revealed. Desperate for dollars to repay their expiring debts, Asian firms flooded the foreign exchange swap market. This is where we must define a critical term, the FX basis. In a normal world, the cost of borrowing dollars using Japanese yen as collateral should be roughly the same as borrowing yen and then swapping them for dollars, adjusted for interest rates. The basis is the extra cost, the premium you pay just to get your hands on dollars. In 1997 and 1998, this basis blew out. The cost of dollar funding skyrocketed, not because of Federal Reserve policy, but because the offshore intermediary system, Box 2, was seizing. It was a global dollar shortage, hidden in plain sight. This fire did not stay contained. The funding stress ricocheted around the world and slammed into a massively leveraged US hedge fund called Long-Term Capital Management, or LTCM. The common story is that LTCM made bad bets on Russian bonds. The mechanical truth is that LTCM was a funding crisis. LTCM was acting as a giant intermediary itself, borrowing huge sums in the short-term repurchase, or repo market, to finance its complex convergence trades. In the repo market, firms use high-quality collateral, like Treasuries, to get overnight cash loans. When the Asian crisis intensified and Russia defaulted in August 1998, a global panic ensued. Everyone dumped risky assets and fled to the safety of US Treasuries. This flight to quality caused a paradoxical flight from liquidity. The repo market, the core plumbing for leverage, froze solid. Investors didn't just want Treasuries, they wanted cash. They refused to lend, even against good collateral. LTCM, leveraged over 100 to 1, found it impossible to fund its positions. It couldn't roll over its overnight repo loans. The firm was days from a default that would have bankrupted its Wall Street lenders. The New York Fed, seeing the abyss, was forced to orchestrate a private bailout. This 1998 intervention was a landmark. It was the first time the US implicitly acknowledged that this offshore, unregulated Eurodollar system was its responsibility. The crisis proved that the stability of the entire system depended on the smooth flow of collateral and the continuous willingness of intermediaries to provide leverage. The arrows on our map were not just lines, they were vital, fragile arteries. The world learned a profound lesson from 1998. The crisis taught global central banks that access to dollars was a matter of national security. The solution? Self-insurance. Starting in the late 1990s, Asian central banks, particularly China, began to accumulate US Treasury bonds on an unprecedented scale. They bought trillions of dollars worth. This wasn't an investment strategy, it was a liquidity strategy. They were building a war chest of the only asset, Box 1 collateral, that the global system accepted in a crisis. This recycling of trade surpluses back into US debt became known as Bretton Woods II. It created a massive, artificial demand for US bonds, which conveniently financed America's growing deficits and pushed US interest rates to rock-bottom lows, fueling the 2000s housing and credit bubble. This new, seemingly stable loop, Asia produces, America consumes, Asia finances, was built on the trauma of one example 998. It stabilized the system for a decade, but it embedded a new, hidden fragility. The 2008 crisis was not a repeat of 1998. It wasn't a currency mismatch, and it wasn't a sovereign default. It was a crisis of collateral quality. The financial engineering of the 2000s had been a frantic search for assets that looked like safe Treasury collateral but offered a higher yield. The result was the mortgage-backed security. When U.S. house prices fell, this AAA-rated Franken collateral was revealed as toxic. The repo market, which had accepted this collateral as good as gold, instantly collapsed. The intermediaries in Box 2 failed not because of a dollar shortage, but because the collateral itself was worthless. This was a much more profound failure, striking at the very heart of Box 1. But even this was not the final act. The system's next great test would reveal the one tool that could save it, and the one weakness the tool could never fix. The 2008 financial crisis was not the end of the story. It was merely Act 2. It was a crisis of collateral quality, where private label junk was revealed as toxic. The system's response, quantitative easing, papered over the problem by stuffing the intermediary banks in Box 2 with trillions in new central bank reserves. This fixed the bank's balance sheets, but did nothing to solve the offshore system's addiction to US dollar funding. This brings us to our critical counterexample, the 2011-2012 European sovereign debt crisis. This event is the key to understanding the present, because it was a crisis that should have collapsed the system, but didn't. As Greece, then Italy, then Spain teetered on default, a hidden dollar crisis erupted. European banks, which held vast amounts of both sovereign bonds and US dollar-denominated assets, found themselves in a familiar trap. Their US dollar funding markets evaporated overnight. Just as in 1998, the FX basis, the premium to borrow dollars using foreign currency, blew out. At its peak, European banks were paying crisis-level prices just to access the dollars they needed to operate. This was a direct failure of the intermediaries in Box 2. The signal was identical to 1998. The system was failing. And then, the system was saved. This is our crucial nullifier. The Federal Reserve, in coordination with 5 other major central banks, activated and made permanent its unlimited US dollar liquidity swap lines. This was the master stroke. The Fed effectively said to the European Central Bank, the Bank of England, and the Bank of Japan, "You can no longer find dollars in the private market, Box 2? Fine. We will print them for you. Come directly to us." This action backstopped the entire intermediary system. It was the ultimate whatever-it-takes moment, proving the Fed was, in fact, the lender of last resort to the entire world. The 2012 crisis was averted, not solved. The nullifier worked. This brings us to today and to the terrifying realization that the 2012 nullifier is now obsolete. The problem is that the crisis we face today is not a problem the Fed's swap lines can fix. The failure is not happening in the intermediary system of Box 2. It is happening in the foundational collateral pool of Box 1. The Fed can offer liquidity to banks, but it cannot force the world to trust the collateral itself. Let's re-examine our mechanism map. Global collateral pool, Box 1. Offshore intermediaries, Box 2. Global leverage, Box 3. The 2012 fix was a bypass for a clogged Box 2. The 2024 problem is that Box 1 itself is beginning to fracture. 3 core signals, all originating from Box 1, confirm this regime change. First is the signal I opened with, the resurrection of the term premium. For a decade after 2008, the 10-year US Treasury term premium was negative. This meant investors paid the US government for the privilege of holding its long-term debt, treating it as a form of insurance. That era is over. The term premium has returned to positive territory and is now highly volatile. This is the market's way of pricing in a new risk, the risk that the US government's fiscal trajectory is unsustainable. The risk-free asset now has a non-zero risk price, a development that undermines every single financial model of the last 30 years. Second, and perhaps most significant, is persistent, record-level central bank gold buying. This is not speculative retail demand. This is sovereign-level balance sheet management. For the last several years, the central banks of China, Poland, Turkey, India, and others have been diversifying their reserves out of US Treasuries and into physical gold at the fastest pace in modern history. This is a direct rejection of the Box 1 collateral. These state-level actors, the largest players in the global savings pool, are making a conscious decision to move away from the Treasury standard and toward a neutral, non-liability asset. They are not waiting for a crisis. They are actively preparing for a post-Treasury world. Third is the persistent elevation of interbank funding stress, visible in spreads like the FRA-OIS spread. This gap, which measures the difference between expected interbank lending rates and the risk-free overnight rate, is a barometer for credit risk within the intermediary system. While not at acute crisis levels, it has failed to return to its pre-2022 lows. It shows a permanent, higher level of anxiety among the banks in Box 2. They are charging each other more for funding, not because of a temporary shortage, but because they are less certain about the long-term value of the collateral sitting on their peers' balance sheets. So, if the Fed's 2012 nullifier, unlimited liquidity for intermediaries, is useless against a 2024 problem of a fracturing collateral foundation, what happens? It means the system's core shock absorber is gone. It means the next funding crisis cannot be so easily contained. The problem is no longer a temporary dollar shortage. It is a permanent fragmentation of the collateral pool itself. This forces us to move from simply observing the problem to quantifying its breaking points. If these signals from Box 1 persist, what happens next, and on what timeline? This brings us to the quantified funnel. The signals from the collateral pool in Box 1 are no longer ambiguous. We can now set measurable thresholds for a systemic transition. Our base case, with roughly 70% confidence, is not a single 2008-style crash, but a permanent fragmentation. The primary trigger for this is the term premium. If the 10-year US term premium, which as of late 2025 has remained stubbornly positive, holds above zero for 2 consecutive quarters, and global central banks continue to be net purchasers of gold, as they have for the last 3 years, then the global system will have officially entered a multipolar, collateral-scarce regime. The historical lag from a structural break in the term premium to a new volatility regime in currency and credit markets has been 6 to 9 months. We are already in that window. The alternative scenario, an acute crisis, is a 20% probability. This would be a failure of market access. The trigger here is precise. If any 2 out of 4 consecutive US Treasury auctions for 10-year or 30-year bonds print a bid-to-cover ratio below 2.0, a sign of catastrophic demand failure, then we would expect an acute funding crisis in the offshore intermediary system, Box 2, within days, not months. This would be the event horizon, a moment where the Fed's 2012 swap line nullifier is proven useless, as the crisis is one of solvency and collateral trust, not just liquidity. The only remaining nullifier for this scenario would be a new, coordinated, global quantitative easing program, a political impossibility in the current inflationary environment. This brings us to the core consequence: who pays and who benefits. This is not a moral judgment, it is a cash flow analysis of the new regime. The losers are the collateral poor. These are nations, corporations, and financial institutions that are dependent on the smooth functioning of the offshore dollar system. Any entity with large US dollar debts that must be funded in the repo or FX swap market faces a permanently higher cost of capital. This includes most emerging market economies, European commercial banks, and highly leveraged US funds. The system, in effect, is imposing a new safety tax on anyone who cannot source their own pristine collateral. The beneficiaries are the collateral rich. This, paradoxically, includes the US government itself in the short term, which can finance its deficits by inflating its own debt away. But the primary beneficiaries are the holders of source assets that are not dependent on the US financial system. This means holders of physical commodities, energy, and most critically gold. The record central bank gold buying is not a bet on inflation. It is an allocation to a neutral, sovereign-grade collateral asset that sits outside the Box 1 Treasury pool. They are building a new foundation. This also explains the focus on certain emerging markets. It is not that China is rising to replace the US in a unipolar fashion. It is that the fracturing of the global system necessitates the rise of regional clearing systems. Capital is flowing to zones that can create self-contained funding and collateral loops. This is the moment to revisit our mechanism map for the final time. For 50 years, the map was simple. Box 1, global collateral, US Treasuries. Box 2, offshore intermediaries. Box 3, stable global leverage. Today, that map is fracturing. Box 1 is splitting into US Treasuries and alternative collateral, gold. Box 2, the intermediary system, is seizing as its reliance on a single, now volatile collateral source becomes its greatest weakness. And Box 3, the outcome, is no longer stable growth, but a volatile, inflationary, and multipolar world. The 50-year-old Eurodollar system is not ending because it was replaced by a superior rival. It is ending because its foundational assumption, an infinite supply of risk-free, stable collateral, has been proven false by its own issuer. The crisis we have been trained to look for is a single, sharp event. But the real crisis is the slow, structural process of fragmentation. We are leaving the unipolar Treasury standard that defined the entire era of globalization and entering a new, undefined order. The question is no longer if the old system is breaking, but what the next one will look like, because while capital is fleeing the old plumbing, it must land somewhere. And the battle to build the new plumbing, the new clearing systems, the new digital collateral, the new monetary anchors, is already underway.